Growing your business can mean big-time logistical questions like, how are we going to keep up with all these local deliveries? Let Uber Direct offer you a helping hand. With Uber Direct, you take orders on your website, app, or by phone. Then drivers who are part of Uber's courier network pick them up from your store and deliver them to your customer's doorstep. Sounds simple, right? Delivery just got better with Uber Direct. Learn more at uberdirect.com. Traffic and value were huge issues in the restaurant business in 2024. Hello, this is Jonathan Mays, editor-in-chief of Restaurant Business, and this episode of A Deeper Dive features some of the year's best podcast clips. Unsurprisingly, a lot of them dealt with the issue of price, value, and weak traffic. We spent a lot of time talking about that issue throughout 2024. Restaurants raised prices aggressively in 2022 and 2023. That led to a lot of frustration over those prices and weak traffic entering 2024, and it would only get worse. It was particularly pronounced at fast food restaurants such as McDonald's, which are normally getting the benefit during times like these when consumers are generally cutting back. In this first clip, I speak with Technomic's Robert Byrne about this topic. We talked about that consumer frustration and what drove it.
The impact is on frequency. And that's really where we see the industry struggling. So I feel as though unless something significant happens, it's a fight they're not going to win because I can only afford to do it so often within reason, right? And, if traffic is what you are counting on to grow your business, there's only so many I can do in a week, a month, a year, whatever it is. And unless I get paid a whole lot more, that isn't going to change. Mm-hmm. So it's a bind. It's a bind. And I don't know what your reaction is to that, because I said a lot, which is what I always do. But that's really what we're seeing. Consumers don't find it more important today. It just means they can't go out and grab a restaurant meal as often as they used to.
Yeah. That's my, my read into a lot of this was roughly the same. I am not blessed with your survey data that you have.
You need only ask.
But I mean, my sense of things is generally because your point, the big point that you made, which is that consumers like going to restaurants, and that's foundational. Mm-hmm. It is absolutely foundational. It keeps this industry driving. It's why consumers have been spending more and more and more at restaurants as compared to of their overall food spending, and that's been happening for ages. It took a break during the pandemic, and now it is back to where it was. But my sense of it is that they're not going as frequently. They're spending the same amount of money. So they might, and I think you've made this point at a previous podcast, but there's still, they might be going out less often. Maybe they're splurging more, though I don't think they're doing that as quite as much now. But they're not going as often as they probably would like. They're not going as often as they had done before. Clearly, in the fast food sector, where you do see overall traffic is down, but they're still spending the same amount. They're just adjusting it. And, we could make an argument, by the way, as to whether that's actually a good thing for operators.
Well,
because you could make an argument, and I know franchisees do.
Yeah.
They might not be as loud about it, and, there is a penalty that brands will pay for lower traffic.
So they will, and you get into a transaction count versus margin conversation is what, I think what happens there. We know that Texas Roadhouse has very plainly said, we've been very happy to forego margin growth and margin health in the name of traffic. And, that doesn't necessarily include extensive discounts or anything like that. They just were able to continue to maintain what they were doing and keep that same price point and therefore value proposition in the mind of their guest. And so their traffic benefited from that. And I would expect operators to do that, to continue to do the same thing. But if we look a little bit closer, the point that I think McDonald's had made as well is that less affluent consumer, that's also clear in our data too. They are the ones that are reducing their overall frequency. Mm-hmm. Whereas those who have annual household incomes of six figures and up actually are slightly increasing their overall frequency. You know, if they're back and out and about, there might be an extra lunch at a fast casual during the workday, or, you know, the extra brunch with the friend on the weekend. Those types of things are definitely happening, but that's only with that segment. It's almost like when people talk about the K recovery from any sort of economically uneven period that we go through, where, you know, those at the top are doing fine and sometimes even better, and those that maybe you just have lower average household incomes are not. And so when we talk about a brand such as McDonald's, where we know that's a significant proportion of their overall guest base, you're going to see it in the numbers no matter what. And that's an interesting lens through which to look at value and what it means. And particularly, I don't know if you're ready to get into it yet, but as it relates to the aggressive push into loyalty program membership and, you know, app ordering and things like that.
Yeah. Oh, I do want to get into that here in a minute, but you said something that I need to ask about. So you're saying that McDonald's is right, that lower income consumers are reducing their overall visits.
Yeah. But what we're seeing is, you know, we ask this question ongoing in pretty much all of our consumer survey data, and it's specific to food service. That's what Technomic does, it's food service, right? So what we ask about is just general overall frequency. And, you know, how often are folks using a restaurant? Is it, you know, a couple times a week, every day, once a week, maybe less than that? And what we find is the percentage of consumers in that 50K and below, they're down about, like, the number that use restaurants once a week or more frequently is down to maybe even 3 percentage points compared to last year. And it's actually up about a percentage point, maybe 2, for those affluent consumers. It kind of bounces around for those in the 50 to 75 and 75 to 100 range. When we talk about breaking out the segmenting the population through that lens. But it's noteworthy because that younger group also tends to fall into that under 50K annual household income group. And they're the ones that really push frequency at restaurants. Their spend per occasion may be lower because it's just me and I just wanted a snack or a pick-me-up. And that's what I can afford because I am earlier in my career and whatnot, and maybe don't have the disposable income that somebody who's a little bit older might. But, you know, it's not just those consumers. It's pretty much all of them. So, you know, as I said, that K that people talk about in terms of economic recovery is what comes to my mind as a visual.
The theme about traffic and value continued in May when we talked with RJ Hottovy, the head of analytical research with the foot traffic tracking firm Placer.ai. RJ and I talked about some of the factors driving that weak traffic, but we also talked about the importance of innovation and why consumers will pay up for things that they really want or view as a very good value. Check this one out.
The value grocery chains, Aldi, Trader Joe's, Lidl, Grocery Outlet, these are the competitors to QSR. So I think you're exactly right. The focus should be on traffic. And, you know, I think it'll be interesting to see as we go through the year. McDonald's obviously talked about a national value promotion. That is probably going to start price wars and get a lot more promotional. We'll see if that is able to claw back traffic for the category. But I think that's the number one pressure is very much inflation is forefront of people's minds. They don't want to spend a lot. They want to stretch their household budget. And if they go into a restaurant and see an entree is going to cost $15 at a QSR location, they're going to find somewhere else.
Yeah. A value war is not, in fact, it's almost here.
It is.
I mean, in early February, when Chris Kempczinski on his earnings call essentially sounded the alarm about traffic. That's why he did that.
Oh, exactly.
He was not just telling analysts that this is a problem. He was telling the broader industry.
No, he was very
and
much so.
Like this is an issue that the industry needs to concern itself now. Because the thing is, like the thing that people forget, their first quarter actually on a 2-year basis accelerated.
Yeah.
Yeah. So and then if you most executives after that earnings call, which was fascinating, most executives would have been like, we did better last quarter.
Yeah.
Because on a 2-year basis, we accelerated.
Yeah.
And we are maintaining share in the industry. That's what we would have heard.
Yeah.
But he's like, we've got issues.
Yeah.
And the general public, and the thing is, like, I mean, you pay attention, like, consumers are really focused on price.
Yeah.
Right now.
We've talked about this before.
Yeah.
The fact that if you look at pre-pandemic to today, the number of visits to grocery locations, it's at its highest point it's ever been.
Mm-hmm.
That is people shopping around for deals. That means that they're going to their normal store less frequently. They're going to more channels. They're going to, I'm going to go look at Aldi for something. I'm going to go to Trader Joe's. I'm going to go to Walmart. I'm going to go check out all these different places. Right now, QSR is kind of falling out of that rotation. And I think that's a big issue. Yes, QSR is off on a 5-year basis in terms of overall business, the category, but not the same order that we're seeing grocery stores, convenience stores, dollar stores. That is where the disruption is happening right now. So I think it's right that Chris was sounding the alarm bells here, because it's getting worse. I mean, this is the trends that we saw early in the year. We've only started to accelerate from here.
Mm-hmm. Yeah. It's, I mean, you probably heard the Walmart earnings call.
Yeah.
And, you know, like actively saying repeatedly, I mean, actually they've been saying it now for a couple of quarters.
Yeah.
That their intent is to get traffic back from restaurants.
Yes. Yeah.
And,
I mean, you can see what they're doing. I mean, prepared meals, private label products. They're going after this category hard. Right. They're not content. Yeah. So I mean, now it becomes what happens to the restaurant scene. Where we can see it. How quickly are we going to see promotional activity, get people back in the stores? It's not just promotional too. It's innovation too. One of the things that people overlook, yes, all the Trader Joe's, they have low prices, but that's not the only thing driving people to the stores. It's the innovation factor. The idea that, I mean, there's a whole set of bloggers and influencers waiting for the moment there's a new product drop at Trader Joe's, and they got to, and people run to the store for it. We haven't seen that level of innovation. We've seen some okay things in the restaurant space, but we really haven't seen that innovation cycle pick up post-pandemic at this point. It's still kind of sluggish, still focused on repackaging old ideas, really, essentially. We're waiting for that new innovation cycle to get people back excited. So I think even though we're starting to see more of a value promotion, it's also got to be some sort of newness with it as well.
Mm-hmm. Yeah, I mean, restaurants got to get people excited about coming in.
Exactly.
They don't, you know, they will spend. They'll spend.
Yeah,
I mean, look at Raising Cane's. Look at Wingstop.
Yeah.
Look at Wingstop.
Big numbers.
40% on a 2-year numbers. Ridiculous.
Yeah.
It's like video game numbers. That's what I told them. And you know, so people will go if you get. And the reason why Wingstop, by the way, can do 20% on 20% is that they got people excited about a chicken sandwich.
Oh yeah.
And it's completely changed the game for them.
It really has. Well, I mean, it's amazing. And then, again, people don't often look at that as an innovation, but sometimes, you know, it's just a little bit extra stuff, a little bit of effort. Sometimes it works like that. So,
yeah, I mean, it's yeah, that promotion or that chicken sandwich might be the most complete new product introduction I've seen. And let me explain that. Because it did two things for them. Well, three things. First off, it was a big sales driver.
yeah.
Right. It's clearly driven a lot of sales, and they are clearly incremental sales. That is a very different product from chicken wings.
And it's an incremental visitor too. It's not just
right.
In terms of new visitors, our data shows completely new audience of bringing in.
Yeah. I mean, which is like, I mean, you are suddenly gaining a completely different customer at a completely different time of day in a completely different occasion.
Yeah.
And it worked. And it was relatively simple for them to do.
Yeah.
And it's the same sauces that they had already. So it fit with what they already did. So not only are they chicken wings, as you know, is a very specific occasion. It's more like pizza.
Yeah, exactly.
And so suddenly they're like a completely different chain. And then on top of it, they sell less wings as a percentage of their total sales.
Yeah.
So they're no longer reliant upon the single most volatile commodity.
Exactly.
I mean, you remember how much problem chicken wing costs would have on Buffalo Wild Wings.
Yeah. Remember that it would be 40 minutes of that on the earnings calls back in the days.
Yeah. Like and then it wrecked the chain at one point. Like
it really did. It really did.
It did.
One of the big issues. Like
yeah, and they couldn't, because their investors or whatever would just freak out for whatever reason. Like this, if you paid enough attention to chicken wings, it is really cyclical. They'll just have a year in which they're insane. The prices go through the roof, and then it just goes back.
It's never a good thing when your commodity cost chart looks like an EKG graph.
Yeah, I know.
It's not a good thing.
Right. And so they're less reliant on the chicken wing. So that got both sales and price.
And margins.
Yeah.
Yeah, that's all exactly right.
Right. It was brilliant and it's just turned out to be really popular. It
reminded me of the chicken sandwich wars a bit away. And so back in, 17, lost a lot of good people back then. It reminded me just, how simple some of this stuff was. I mean, it was putting, this basic chicken sandwich on the menu and what it did for Popeyes, and it repositioned the entire brand. So in a lot of ways, it reminds me of that. It's a different situation with wings and what Popeyes had, but there are some similarities there.
It is. Like, yeah, I mean, it's easy to forget how the chicken sandwich at Popeyes was a big deal.
Yes.
And it changed the trajectory. I mean, you could look at their numbers. So I just published a story on this. They were doing pretty well before then, and then it just put them in a different place.
It was like nothing else.
Yeah. And but I don't think most people really appreciate how difficult it was for a bone-in chicken chain
Exactly.
to sell a chicken sandwich.
Yeah.
And both chains have been trying to do it for years and fail.
And not gotten very far with it. No, exactly.
No. Remember the KFC Zinger?
Yeah.
It was a Zinger. That thing is a monster internationally.
Yeah. Oh, absolutely.
Like KFC internationally, by the way, it's just like a vastly different.
It's a very different experience.
Yeah, very different experience. And they can't bring that same sensibility to the United States.
Nah.
And the Zinger, they thought that was going to be, we're going to bring it to the United States, and it's finally going to crack the chicken sandwich code, and then nothing. And then so Popeyes was able to do that.
Yeah.
I mean,
yeah. It's that whole category. I mean, it's just amazing looking at the visitation numbers. I mean, we talked about QSR not picking up, as much as grocery and other food retail channels, but chicken is one I would exclude from that. That's obviously been a category. I mean, Chick-fil-A continues to be crazy. I mean, Raising Cane's. I mean, any of the chains. I mean, and we've got this whole, the hot chicken concepts are right behind it that are doing really well. Dave's doing incredible numbers. We do a lot of work for our QSR customers, and we do cross-visitation who are their direct restaurant competitors. It's almost always Chick-fil-A, Raising Cane's, and then a third chicken concept. Then you get maybe McDonald's and somebody else. It's amazing how many times they pop up in the rankings. It's almost across the board.
We also enjoy talking every year with Hudson Riehle, the Senior Vice President of the Research and Knowledge Group with the National Restaurant Association. Hudson and I talked about the overall state of the restaurant industry, how big it had grown, and some of the key issues driving restaurant industry success this year. Check this one out. Throw out some numbers from the report. $1.1 trillion total sales, 1 million plus outlets. I assume you mean generally restaurants, but I'm going to get to that question in a minute. And then 15.7 million employees. I mean, the one thing that stands out to me always is, the industry is a lot larger than I think people really appreciate. It is a massive employer. And I think your numbers, show that 1 out of 3 Americans at one point in their lives worked at a restaurant. McDonald's, by the way, will tell you that 1 in 8 of Americans, which is mind blowing. And I'm one of them. Yeah. 1 of 8 Americans had spent time working for the Golden Arches. So it's a big industry. I mean, it's a large and massive employer and economic generator, which I think people don't quite appreciate.
Exactly. I mean, currently, it's roughly 1 out of every 10 Americans working actually works directly in the restaurant industry. The restaurant industry is the nation's second largest private sector employer. And within the hospitality industry currently, even 4 years after the pandemic, there's still roughly about 900,000 openings just in the hospitality industry. So, when we survey restaurant operators, not surprisingly, their current challenge remains labor recruitment. Mm-hmm. And, it is better than it was 2 years ago, that's for sure. But in terms of their ability to not only recruit labor at these substantially higher price points, but the availability, and now you throw in this irregularity of customer patronage patterns, profitability does remain under pressure. Mm-hmm. And so, we survey restaurant operators about their thoughts about profitability. And it really is surprising the high numbers that indicate between the labor cost pressures. And, you can look at labor cost pre-pandemic and during the pandemic and where we currently are. These 3-year periods, if 24, 23, 22, and this is based on, Bureau of Labor Statistics data, those average hourly earnings are at record high annualized rates 3 years in a row. So it is the labor costs are coming down. But the fact is, it's like food costs. Once they go up, there may be a little disinflation, but it's certainly not deflation. And so with those input costs, it is a challenge for operators across the country to remain a viable, ongoing business concern in this tight profitability situation. And the typical annualized sales volume of a restaurant in America today is just $1 million. And so if you think about that, it comes out to an average of just about $2,700 a day. And then if you break that down further, say a small independent can get a pre-tax profit margin of 5%. You're talking between just roughly a couple $100 of pre-tax profit per day. So it's extremely fragile situation, and that's why you're seeing new business models and real estate pad sites changing, because that traditional model in this environment of such sustained menu price inflation and labor price inflation, it's one thing. I mean, if you think about gas prices and how that's always applied pressure on the industry and the increases in that situation, it's not only the price level, but how long it remains at that price level. And in general, particularly now, you've seen gas prices come down over the past year, so that's a plus. But looking at the levels that the labor costs are now at and the duration of this, it fundamentally changes how labor has during the pandemic and will continue to be differently deployed in a typical restaurant operation. And as you well know, that's one of the reasons that the technology focus is front and center now, because with such a labor-intensive industry, you can look at sales per employee in the industry, and it's just $83,000 a year, roughly. And so other retail businesses overall have about $460,000 per employee, and they're capital-intensive industries that have, several $1 million a year per employee sales. So the industry has always been extremely labor-intensive, but the fact is, particularly for off-premises and to some degree on-site, there still is a lot of productivity and efficiency gains which can materialize. But the challenge is, particularly for smaller operators, is not only the initial upfront investment, although the economies of scale are getting better, but it is a situation where, particularly among younger consumers, their expectation is that restaurant experience incorporates some aspect of technology. And so going forward, when we survey restaurant operators, we ask them, are they What are they investing in currently regarding technology? What do they expect to do this upcoming year? And the fact is that they are stepping up their tech investments, but it varies substantially, as you would expect, not only by type of operation, but even in terms of a lot of the geographies which have different labor market conditions. And, that's another thing that as the years have ticked past, the variability in the local economies is substantial now. And in essence, we always say the best trading areas end up be the ones that have the higher population growth rates, and allied with that is the higher employment growth rates. And as a consequence of that, you get higher income growth rates, and then that translates into higher restaurant sales growth rates. And so that remains a very fundamental axiom of success long term. And that old saying, demographics is destiny, is so true now, because there's still, amazingly enough, over 24 states that still have fewer restaurant employees in them than they did pre-pandemic. And it's just recently, in the past couple of months, that overall restaurant industry employment has actually reached where it was roughly pre-pandemic. But there's a host of variances behind that top line number. So, for example, if you look at table service restaurant employment, it's still down 4 years later, almost 250,000 employees. And conversely, if you look at quick service employment, it's up by roughly almost that same amount. And another interesting development as an aside is that employment in bars and taverns has gone up too. So during the pandemic, we think that traces back to the focus on the neighborhood establishments where you didn't have to transit far to go out. And so it is structurally a different industry overall. And within these different segments, there are fundamental differences in terms of how that path to success is achieved.
And that should do it for this week's episode. We are going to take a break for the rest of the year to celebrate a couple of holidays, but we will be back in early January with some brand new episodes. Thank you, everybody, for listening and making this such a great part of my job. Growing your business can mean big-time logistical questions like, how are we going to keep up with all these local deliveries? Let Uber Direct offer you a helping hand. With Uber Direct, you take orders on your website, app, or by phone. Then drivers who are part of Uber's courier network pick them up from your store and deliver them to your customer's doorstep. Sounds simple, right? Delivery just got better with Uber Direct. Learn more at uberdirect.com.